Hello, traders and investors. Have you ever asked yourself if your strategy really works or if it only worked because of luck? In the financial market, trading without backtesting is like driving in the dark. You might go far, but the chances of crashing are huge. In this video, you will learn everything about backtesting in MetaTrader 5. What it is, why it is essential, how to interpret the results correctly, and most importantly, how to identify a truly promising strategy before risking real money. If you want to trade based on data, not guesses, stay until the end. But before we begin, give us a thumbs up and subscribe to our channel to learn more about trading strategies. What is backtesting in MetaTrader 5? Backtesting is the process of testing a trading strategy using historical market data. In MetaTrader 5, this is done through the strategy tester. Basically, you simulate trades in the past to see how the strategy would have performed. You can also check loss, drawdown, winning, G, and losing streaks. Backtesting does not predict the future, but it reveals patterns. S and patterns are everything in trading. Why is backtesting important? Backtesting exists to reduce uncertainty. It shows whether a strategy has statistical logic or if it is just an illusion. Without backtesting, you trade on impulse. With backtesting, you trade with confidence. It helps answer critical questions like, is this strategy profitable in the long run? Does it survive crisis periods? Can it handle losing streaks? Backtesting does not eliminate risk, but it eliminates ignorance. Types of backtesting in MetaTrader 5. In MT5, you can perform backtesting in different ways. Automated backtesting using expert advisors, manual backtesting by analyzing historical charts, backtesting with real tick data, backtesting across different periods and assets. The more accurate the data, the more reliable the results. Bad data creates dangerous illusions. How to properly configure a backtest in MT5? Wrong configuration leads to false results, and false results lead to real losses. It is essential to choose the correct asset, the appropriate time frame, a long enough historical period, and realistic trading costs such as spread and commission. Short backtest lie. The market changes and the strategy must survive those changes. How to correctly interpret a backtest. This is where many traders make their biggest mistake, looking only at the final profit. Profit alone means nothing. What matters is the full picture. Analyze the maximum drawdown, the consistency of the results, the risk to reward ratio, the equity curve behavior. A strategy that grows steadily is more valuable than one that explodes and collapses. Consistency beats emotion. These are the essential metrics to analyze in a backtest: profit factor, mathematical expectancy, win rate, absolute and relative drawdown, and total number of trades. A good strategy does not need to win all the time. It needs to win more when it wins than it loses when it loses. Here's the best way to identify a promising strategy in a backtest. A promising strategy leaves clear clues. It works across different market periods. It does not depend on a single specific year. It maintains its logic even when parameters change slightly. If small adjustments destroy the results, this is a red flag. Robust strategies survive imperfections. Fragile strategies only work in perfect conditions. Check the video on the card to learn more about this method. And here's the most dangerous problem when optimizing a strategy: overfitting. Overfitting happens when you over-optimize a strategy for the past. It looks perfect on historical data and terrible in the real market. The more complex the system, the higher the risk. Simplicity tends to be more robust. The market rewards logic, not indicator overload. Backtesting is not a guarantee of profit. but it can tell you important information and help you to be more secure about the strategy. This needs to be very clear. Backtesting does not guarantee future profits. It is a validation tool, not a crystal ball. The market changes. Unexpected events happen, and no strategy is unbeatable. But those who test make fewer mistakes and learn faster. If you take trading seriously, backtesting is not optional. It is mandatory. It separates traders from gamblers, real strategies from illusions, consistency from temporary luck. Before trading in the real market, test, analyze, and adjust. Because in trading, those who respect data survive. That's it, guys. Share with us what you think about backtesting and how you make your test. See you in the next video.